Hey, welcome to the live stream. It is Sunday, March. Can you believe it? March 2nd. We're done with February. And man, the stock market was so angry in February. I'm glad we're done with February. Man, especially last week at certain days, it just seemed like somebody got the stock market gods angry and they were throwing lightning bolts down on Wall Street. It certainly felt that way middle of last week. I had a stupendous January. My portfolio just went up in value like you wouldn't believe. It was just such a beautiful month. And then I gave up a lot of the gains in February. Not quite all of them. I'm still doing okay, knock on wood. But February just was such a volatile month that took technology stocks down. And in general, I think it's good medicine. I think it was some pretty good medicine to come into the picture where some stocks were getting euphoric, a little too euphoric. You're seeing some stocks go up like literally 100% in a month or 2 months. That's just not gonna, it's not gonna work long term, man. It's fun to see it, especially if it's one of your own stocks. Like Robinhood really did well, but man, it needed to come down so they could get back down to a reasonable level. And I think we are seeing some rational trading, I guess, bringing down some of these stocks that were high flyers. So that was good to see. That was good to see. Overall, I think um, the NASDAQ year to date, where is that thing? It's still down. We're still, if you're indexed on the NASDAQ, you're losing a little bit of money. How about the S&P? You're making a little money with the S&P. How about the Dow? Dow's ahead a little bit. So looks like the safer bets are making a little more money. And keep in mind, bonds have been flourishing in 2025. Whenever the stock market gets really crazy, volatile, the bond market does really well. So that was the case with bonds over the last month. They did really well. I was doing like some performance reviewing of my portfolio. I'm doing okay for 2025. Not quite as good as last year. I am beating the market, but my bond portfolio, it's doing what it's supposed to be doing. It went up in value, delivered good income, and makes me want to put a little more money there, man, because it was a pretty sight to see that the bond portfolio was nice and green. Now you're not going to hit any home runs or grand slams with bonds. You're only going to go up maybe 5-10% at a year at a time. But when you have stocks that are really going down, let's say you had a down year like 2022 where the S&P was down 20-25%, while bonds were up like, maybe 5%. Combined, you beat the market by 20-30%. So anyway, that's enough of bonds. This is a stock investing channel. So let's talk about stocks. Looks like we're already 11 strong. Thanks, everybody. Looks like Trader Prad's out there. He's like a tiger in the tall grass, ready to pounce and trade, scalp some stocks. I don't even know half the stuff that he says. It sounds so cool, but I don't really know because I'm not a stock trader. He is a stock trader. He's got his own channel, and I'm a stock investor. Rotel and Cheese, making some money on Coinbase, huh? I hope it goes really well for you tomorrow. Bear Light, thanks for tuning in. Looks like Joey, good to see you again. And your question, do you think this week will be down week because of tariffs? Tariffs are showing up. I know with Hewlett Packard, I did a video on HPQ and they came out and said it, they manufacture everything in China. All their computers and stuff, they get manufactured in China. So the additional 10% on China is really going to affect them. It's going to cause them to either shrink their shrink their margins or raise their prices. Both are bad choices for them. So we'll see how it goes, but it's already affecting some companies. RJ Martino 2000. Stocks take the stairs up, the elevator down. You're right about that. Yeah. I think the expression is they take the escalator up and the elevator down. And you're right. If you've ever been to those high-rise buildings in New York, and there's like 60 or 80 floors, and it's always amazing when you go down, it takes like 10 seconds and you go from like floor 60 to the first floor. And I'm always amazed, like, wow, that was fast. Why didn't I feel it anymore? But that's how good the elevators are now. And that's what happened last week. It in some stocks, like Nvidia, it went down 8%. Wow, that was amazing, as well as some others. Carlos, good to see you. Rotel and Cheese. GLBE has hammered because of tariff talk. Yeah, let's take a look. So we'll look at coin since you brought that up, and then GLBE. That looks interesting. All right, so the format of the live stream, I'm going to have some opening remarks just to kind of get things moving. And if you guys want to put some stocks in the chat, we can take a look at stocks. Now, keep in mind, we've been getting upwards of 20 to 25 symbols put on the chat. So if you put one out there, please be patient. I can't obviously do everything super fast, or it wouldn't make any sense. So put them out there and I'll cover them. And if you're a paid member, put your stocks out there. I'll put those as a priority, as a courtesy for all those people that are supporting the channel. All right. So it looks like Mike, the dividend investor guy. How you doing, buddy? Nice GCT. Yeah, I've been very surprised as how nice the software company hasn't done much. It has been kind of a tough market for technology, but I'm going to hang in there. I don't want to give up on nice. And then GCT, that one's a little small cap. Small caps, when you see this volatility, man, it could really chew up small caps because they're probably less favorable to investors when things get really risky. They want to go to something that's safe. They want to go to consumer staples. They want to go with, McDonald's. They want to go with Walmart, Costco, go somewhere safe. They don't want to go to small caps, but it might become an opportunity. We'll see. The small caps, and I'm going to show a couple that are in healthcare. I'm really excited about healthcare, especially small caps in healthcare that are making a lot of money, cash flow, growing. They have everything that I'm looking for. So I think healthcare is going to continue to outperform, and that's where I'm looking for small caps. So it looks like DKNG, is that DraftKings? And then TKO. We looked at TKO a while back. What's up, Pedro? Good to see you. All right, so let's kind of see where we're at with the market here. The sector that's in first place right now is healthcare, 8.57 higher than at the beginning of the year. And it's good because it hasn't been performing like it typically performs. I've been investing in healthcare for 20 plus years, and these last 2 years have kind of been weird years. Consumer staples in second place. Understandably, investors want to go to a safe stock. I don't like consumer staples, but that's just a general comment. Financials are okay. Those are the top three sectors. So when we talk about small caps, I really like small caps in healthcare. I like healthcare, period. I think it's going to work in 2025. I've got a good number of stocks that I own. I want to buy more shares in those stocks. And I'm trying to qualify in one more small cap to put into that list of stocks that I want to own in healthcare, because I think I'm going to bet a little bigger on healthcare and see if that's going to help me beat the market this year. So healthcare is in first place. The mega caps, most of them are red. Apple's down this year. Nvidia's down. Microsoft is down. and Google is down quite a bit. And Meta's still in the green, but they were up 25% in 2025. It's like they came out of they came out just so strong this year. They've given up 11% gains, and they're down to 14, which is still good for 2025. Berkshire is really consistent, moving up the list. Now number 7 spot. Nice. Tesla has just been getting pretty beat up. It's in for sure correction territory. I don't know if anybody would label it a crash. I mean, it's 25%. It's in bear territory. It's not doing well. And I think Broadcom here down 14. I would not be surprised if this continues to go down. I think Broadcom rode the coattails of NVIDIA. It rode the data center build out. But Broadcom is a good semiconductor stock. It's a good one. I owned it. And they are a combination. They're also a software play because they acquired VMware. And so that's in the data center. But VMware doesn't have a whole lot to do with AI, by the way. VMware lets you virtualize servers and get more out of a particular piece of technology. But, hey, the market's just taking stocks to greater heights no matter what they do, it seems, that are involved with the data center. So that's what's going on there. Now, this stock here, Eli Lilly, it's up 19%. This is healthcare. This is the biggest healthcare stock out there. And these stocks, I think, are going to move up. This one, United Healthcare, and others, I think, are going to start moving up the list. All right. So some earnings. Tomorrow isn't a big day at all. It's Okta's coming out. This is a smaller software company. I've looked at Okta. I'm not overly excited about that stock. Once we get to Tuesday, we got Unilever, CrowdStrike on Tuesday, Sea Limited. And this is Diageo. I'm not sure what they do. I think they may do travel, but I'm not familiar with that one. AutoZone, Target, Ross Stores. So no big, huge names, but a couple recognizable companies. Wednesday, Marvell, Zscaler. Looking forward to that one. MongoDB. That's a software company. So some smaller names. We're through all the big names. Oh, here we go. Broadcom is on Friday. After the close on Friday. That's kind of let's see here. Thursday. No, it's going to be March 6th, Thursday. Broadcom's going to report after the close. Then Costco. So Thursday is going to be kind of a big day. We'll see what Broadcom has to say. And just remember the Broadcom earnings mixed in there is the acquisition of VMware. It's not organic growth. So you see a big growth number from year to year. Keep in mind, it's that acquisition of VMware that's showing substantial growth. So, and they do have a high amount of debt on their balance sheet. So you got to keep that in mind as well. We got Kroger on Thursday as well. Samsara, Guidewire Software. So we got a couple of good names out there. So it should be an interesting week, but not as I think as high stakes as it was this past week. The NVIDIA earnings was a huge moment. All right, so how you doing, Shadow Guy? Good to see you. Cool. Thanks, Shadow Guy. All right, so just real quick, I'm going to go over a couple of healthcare stocks. Halozyme. This is a $7.23 billion market cap company. Its revenue is about $1 billion. So you're paying about 7 times revenue for the company. Forward PE is only 12. This is a smaller cap. These guys research, develop, commercialize enzymes and devices in the US, and they're basically injectable biologics. So they're a San Diego company. And when I look at this company, it's a 22% grower. It's already a $1 billion revenue company. If you look at the last quarter, they grew at 29%. So I really like the growth. When we look at their margins, gross margin 76%. They've been expanding those margins. Looks good. And profit 43%. Holy smokes. Free cash flow margin 46%. Wow, that's a good profitable business. So very high margins, high growth, high cash flow. Healthcare. Year to date, it's working. 1 year, working. Man, this thing's solid. So let's do a full evaluation on this puppy and see what this thing is worth. I haven't done an evaluation on this company. I found it on a screener that I put some hours of analysis into yesterday, and then I presented it to my fellow investors on the investor call earlier, and I wanted to do the full evaluation on the live stream. So I'm going to switch to another screen, and we will do a full valuation. So I will marry this up with Catalyst Pharma, which is right in their industry, and then we'll set this thing up. So I saw a good interview of Bill Ackman, Pershing Square, and he talked about how he values companies based on the expectation of future cash flows, which is what he learned. I think he said the first book that he read was Benjamin Graham's investing book, and that he said that it changed his life. And I agree with Bill Ackman that if you learn to value companies based on free cash flows, it just gives you a sense of when companies are priced too high and when they're too low. It just gives you more information. And he's looking for companies that are priced well below their intrinsic value, which is basically cash flows, what you expect out of cash flows in the future. So let's see what we expect out of our friends over here at Halozyme. Now I'm in California. Halozyme is down in San Diego, and there is a thriving life sciences industry in North San Diego. There's a big university there, UC San Diego. They put out a lot of talent of people that graduate in biology, chemistry, all that good stuff. All right, so what kind of cash flow are these guys producing? Well, let's take a look. The trailing 12 months really was the last completed year. They did $468 million of free cash flow. Okay, that's a good start. Now, these guys are growing at 22%. Free cash flow is really growing fast. It's growing more like 35%. Now, I'm not going to grow it by 35%. That'd be a little too, you know what? I think I made a mistake here. I think I want to undo that. Okay. So they're growing revenue by 22%. Free cash flow is growing by more than 30%. So I'm going to grow the first 4 years. I'm going to go like 18%. And this number, what I'm doing here is I'm setting up a cash forecast. Let's forecast what we think the cash is going to be in the first 4 years. And first 4 years will grow it at 18%. And then on year 5, it's going to start growing by 4%. And this will set up terminal value. Terminal value is all cash flows past year 4. When we look at the discount rate, I'm going to use a discount rate of 10%. I think that's fine. They have a good balance sheet. So the intrinsic value is $12 billion. In fact, I'm thinking maybe 22% might be better because they're growing cash flows much faster than 22%. So let's go with that number. All right. So cash on the balance sheet. What do we have there? So we have 596 million. And then total debt is $1,540 million. So we have equity value of $12 billion after we deduct that debt. Now we've got shares outstanding, 123 million shares. So the stock price is $59.15. So the forecast that I have for cash flows based on their growth rate, their industry is pretty valuable. Those cash flows are worth $13 billion. I'm going to take away about a net $1 billion out of that because they have debt. Gets us down to $12 billion. Their current market cap is only $7 billion. So 68% discount when I compare the value of the cash flows per share versus the current stock price. That's looking really good. Looking real nice. Let's take a look at the forecast. And let me show you the forecast that investors have for this company. 9 analysts are covering this stock. Some of them are optimistic. Price target $75 a share. The average is $62 a share. And the low point isn't too low, $49. On average, they say it's discounted by 6%. Interesting. What I like seeing here in stock analysis is that these analysts put their analysis together, and then you have kind of a consensus growth for the company. For the current year that we're in, they're supposed to grow at 19%. That's good growth. Next year, 23%. And then from there, kind of still growing, but as they get bigger, it gets a little harder. I like these growth numbers. I really like those growth numbers. That is steady growth. Steady as we go. Okay. So I'm going to use a 5 PE, which is what they are expecting to do here in 2025. And look at how they've expanded from 2024 to 2025. That looks really good. And I'm going to grow it by 20%, and I'm going to give them a PE of 24. All right. So that is $5 per share, PE of 24, grow it by 20%. I mean, this stock's looking good. And it's not like a big giant surprise that nobody's paying attention, because there's some people making money on this stock. And it had a nice pullback here, and now it's beginning to work again. And over the last 5 years, you're up almost 200%. Man, this one looks good. I went through a full stock screener. I looked at healthcare stocks. This one was one of the best ones that I ended up finding. And it looks really good. So this one here is going to go on my watch list. I'm going to sleep on it, think about it, maybe even pray on it. You know, it wouldn't hurt. Throw a prayer out there. Maybe the Wall Street gods won't be as angry this week as they were this past week. And this is healthcare. I like pharmaceutical, biotech companies. They kind of, if you look at their financials, they kind of look like software companies, and software companies look like them. And the reason for it is very high margins, high cash flow, and their valuations. Biotech companies go up in value fast, like good software companies. And the science, you know, once you get those patents become a barrier of entry. You have a patent for 20 years, you get to sell that pharmaceutical for a good price for a long time. If doctors believe in your science and believe that that drug is going to help their patients, they will send patients to you. That's a very good situation. Everybody wins. The patient wins. They get healthy. The doctor wins. He's providing health care to his patient. It's just a good situation for everybody. So I like biotech. I like pharma. And this one here, I think I've uncovered a nice little winner here. So I'm going to take a look at it. Now, that's the same process I used when I found Catalyst. This has been a winner. This had a great couple weeks, just to kind of show an example of what I'm trying to do again. And Catalyst has been performing really nice. And this is Catalyst Bancorp. That is the wrong one. So this 1 year to date's up almost 10%. It's up 59% in the 1 year, up 447%. These stocks, again, this kind of looks like a technology stock with the kind of appreciation we're seeing here. This is a healthcare company. It's a biotech company, biopharma. So that's why I'm looking here, is I think there's some good value. And look at this company I showed you, the PE is 12, and the growth rate is in the 20s. The last quarter was at 29%. The margins are fabulous. The free cash flow is tremendous. I mean, everything is checking all the positive boxes. I think Bill Ackman would be in approval if he was in part of my investing committee. He'd say, go for it. Green light on Halo. So Halo gets a little star next to its symbol here on my notepad. It is a positive stock, and glad I found it. The weekend was productive for me. The other stock that is looking good, hold on a second. Let me catch up on comments here. It looks like we're 23 strong. Everybody, if you just joined, let's let you know we're looking at stocks. We're going to look at them through the lens of an investor. We're going to try to see if they're currently trading above or below their intrinsic value. Predominantly the intrinsic value based on free cash flows, and then we'll also look at earnings per share. All right, so catching up on comments. They're coming in fast and furious. Mike, I got your comments there. We got DraftKings, TKO. All right, so Shadow Guy is out there. Lardog, good to see you, man. Yeti. Is this the Yeti, the ones that do the coolers and stuff? Let's take a look. For a while, those guys were really hot. They're very popular. We'll take a look. Just be aware you got 7 stocks ahead of you. So Mike, the dividend investor guy. Also remember that tariffs for Canada and Mexico also increased for CHN. Yep. So is that a comment for another person on the stream? Nicolas, good to see you. First time. Hey, good to see you. Thanks for joining. You're in Spain. Thoughts on Oscar? Happy to talk about Oscar, man. That is one of my new positions. And I'm going to show you the screener results that I came up with. So this was several hours of work that I took every healthcare stock, right? This is a long list. And then I basically began to filter based on the free cash flow yield, margins, and so forth. And I ended up with the best 19 very good quality stocks, small, big, medium, everything. Who's at top of the list? Oscar Health. These guys are making it happen. Free cash flow yield of 30%. Gross margins. Forward P just 19. Not only that, super investors are invested in Oscar. So yeah, I'm big on Oscar, man. And I've got a quick valuation that I could show you. And I did a video on my channel if you want more details beyond this conversation. This thing looks good, man. It's got great cash flow. Again, I'm trying to find companies that are trading at stock prices well below the value of the expected cash flows of Oscar Health. This case here, the cash flows look stupendous. And they're so good, I have to tone them down. I have a negative growth rate in year 2, 3, and 4 because I don't want it to get too, optimistic. Even when I tone those free cash flows down and I use a reasonable growth rate in terminal value, I still get an intrinsic value of those cash flows well above their current market cap. So Oscar Health looks really good. I also like what they're doing as a business, right? They're trying to go to the small business individual to sell insurance products. That's a really good idea. The big guys aren't going to try to go after Oscar. They're going to let them operate there, probably grow for the next 5 years until they get big enough, and they'll probably acquire them, which is probably what'll happen. So I'm big on Oscar, man. Oscar checks all the boxes for me, and I am currently buying into that stock. Thanks for asking. All right, so we knocked off Oscar really quick. That was an easy one. And Michael Burry's buying an Oscar, by the way, the famous short seller on the subprime market. RJ Martin. So the investor call is for paid members. You can go on my YouTube channel. If you become a member, you'll get an invite and then you can join the call. It's a conference call. We talk, it's not like this format where I'm the only one talking, and you're welcome to check it out. If you need any detail, please reach out to me and I'll be happy to provide it. Mike, the dividend investor guy. So you sold CPRX at the last pop. I remember. Well, you made some money, man. You rang the cash register. That's great. So live every channel. So you want to look at LW? Let's take a look at LW. So REGN, why isn't that on the list? We'll take a peek. We'll take a look and I'll try to answer that question. And then AES, a utility company, man, the AI buzz, right, has made utilities cool. Now, I never thought utilities were cool, but now they're cool. Everybody wants to know about utility companies. Nico Rocan, gracias, amigo. You've been growing a position in Oscar. All right, cool. Good luck. Good luck. All right, so let's move on. We handled Oscar already. We did a quick hit there. I'm going to come back to EXEL a little later, but let's touch on, I'm curious to see GLBE. That was brought up earlier. So GLBE, Global E Online Ltd, together with its subs, provides a platform to enable and accelerate direct-to-consumer cross-border e-commerce in Israel, UK, the United States, and internationally. Its platform enables international shoppers to buy online and merchants to sell from and to worldwide. Interesting. So they're in Israel, $7 billion market cap. We are looking at US dollars. Revenue is 752. You're paying about not quite 10 times, a little less, maybe 9 times revenue for the company. Forward P, it's a little high, 52. $52 PE. Analysts like it. Strong buy, 36% discount. Let's take a look at this growth. 32% growth. Looks good. This is in US dollars. $752 of revenue, growing at 32%. Last quarter growth, 41%. Wow, good momentum. All right, so we got a company that it's small, but it's pretty good size. 752 million, growing at 32%. And when we look at their free cash flow, see how they started to do low cash flow, kept growing it. Now they're up to $167 million of free cash flow. Very nice growth. And the growth rate is like 60%. So can't use that as a forecast, or the number would just go through the roof. Gross margins of 45%. They're e-commerce, so it's not going to be like the biotech company or the pharma company we saw earlier. Free cash flow rates 22%. So those numbers look really good. I would take, based on the cash flow growth, I would be like, 20 times that free cash flow. So that makes them call it 3.2 billion, depending on how much debt they have. They have almost no debt. So they have a nice cash balance of $450 million. So that's interesting. Their market cap 7 billion. The cash flow they have is only 167. So if you multiply this times 10, we get 1.6 billion times 20, 3.2 billion. And I don't want to go any higher. And the reason for it is I'm in the US. Whenever I invest outside the US, I have to discount that investment higher because it's more risk to me. So I'm not going to go 30 times, which would be a higher multiple. And at that rate, I'm at like $3.2 billion of value. You add that cash down on the balance sheet, maybe we get to 3.6, 3.8. And that's well short of the $7 billion that are out there. The stock's been okay. Nothing, not breaking any records. And this one is a pass for me. There's also, and keep in mind, this is the point of view of a US investor. I'm a US investor, so I get to invest in Amazon. I already invested in Amazon. Oh, well, how about Alibaba? Alibaba has numbers that look better than this, and they're much bigger, well-known. I'm an investor in Mercado Libre. Their numbers look better than these. And just, off the top of my head, I'm an investor in those three stocks. So this one here just can't compete against those three. They'll have the most amount of money invested in Amazon, second most in Baba, and then I have a small position in Mercado Libre. So this one's a pass for me. Analysts are going to base their valuations based on earnings per share. 12 of them cover the stock. They're saying, hey, the upside's 66 and the low side's even 45. So they're thinking it's really discounted. And they're thinking because earnings per share is going to drive a valuation. The revenue is going to continue to grow nicely. Very good. But they're just not going to achieve great profitability and great free cash flow. So I am out. It's not a stock that I'd be interested in because of that cash flow. Bill Ackman said he values companies based on his expectation of future cash flows in that business, discounting those future cash flows to today's value. That's what gives an investor like Bill Ackman the starting point, or maybe the basis of making an investment. So I'm going to stick to that free cash flow. Another key point is that PE is kind of high at 52. So that one's a pass for me. All right, let's talk a little crypto. Coinbase. Now, Bitcoin was down last week. And look at that. It closed at the end of the trading session. That is a little bit of a surprise. I had so many things to check on Friday. It was kind of an amazing close, right? It was just a really awful week. And I thought it was going to be an awful Friday to cap off the week. And then stocks rallied and Coinbase ended up picking up the rally too. These guys are unique. $54 billion market cap. It was doing great as an investment. And now it's only up 8%. But at one point, this thing was just crushing it right around the election. These guys just took off. They gave up a lot of those gains. Year to date, they're down 13%. Over the 5 year, they're down 13%. Now, I invested here, so I'm doing just fine on Coinbase. Got a nice position in Coinbase, and it's going to stay that way. I've picked up shares from time to time, but I have a very nice basis, and I'm going to keep it that way. It is a riskier stock because it's such a new industry. We look at their forward P, it's 28. Now, these guys, back to that cash flow, right? Do these guys generate cash flow? Free cash flow, $2.5 billion. Oh, man. Coinbase. You blow my mind. You multiply that times 20, we're up to their valuation. But you could actually multiply that times 30 or 40 because Coinbase is the best in their category. There's no other publicly traded company that does crypto. They're the brokerage that does crypto. They're cleaning up when it comes to institutions that are getting into crypto. They're using Coinbase as a partner that they go to because they know crypto, and now whatever it be, Charles Schwab or whomever else can offer that asset class, but they're using Coinbase on the back end. So they're cleaning up when it comes to institutional investors. They're cleaning up when it comes to retail investors. I know some retail investors don't like them because they charge higher fees. I get that. They don't have to be everybody's favorite to be really wealthy and valuable. They just have to be a good operating business, and they are. So they're doing quite well. Their stock has really come down recently. I'm, keeping my shares. I don't think I'm going to buy any shares right now. I think I've got enough shares. If I didn't own shares, I'd be buying shares. So this is a buy for me. When I value Coinbase, and I've been tracking, I've been a Bitcoin investor since 2018. So I'm not the most experienced person when it comes to crypto, but I'm not, just getting started either. I think the stock's discounted by 37%. Those cash flows are worth a lot. And then the earnings per share even drive a very good valuation. So I'm good with Coinbase. I've got a good solid position in Coinbase. If I didn't have any stock in Coinbase, I'd be buying Coinbase because I think it's a really important business. They're the number one business in their category. They produce free cash flows that are really exciting, and they keep getting bigger and bigger, more powerful. So that is Coinbase. Now let's talk about Nice Software. Nice Software has fundamentals that are just phenomenal. This business is a software company. They do customer experience, contact centers, and everything to do with, managing that relationship with a customer. And they've just been sold off. They're like the industry, or the stock market, I should say, just doesn't like this stock. The stock market has decided that software companies are not that cool anymore. They're not desirable. And I'm not going to argue with the stock market, but I think it's wrong. Software companies make so much freaking money. Let's take a look at Nice. PE 11. Well, that looks good. Market cap 8.8 billion. You're getting the company for 3 times revenue for a software company. These guys are located in Israel. They are building good AI products. Yes, AI products that are real. And they have a legacy business that is a contact center business. $2.7 billion of revenue, and they're growing by 15%. The last quarter, they grew at 15.79%. That's very good growth. Very good growth. We go down to their free cash flow, a beautiful number of $800 million. Their gross margin, 66%. Free cash flow margin, 29%. What does business need to do to get a fair valuation around here? These guys are just a really solid business. Now, the big spook on software companies is AI is going to replace them. They're not going to be able to sell their software to businesses to sell them more units and find new customers that want to buy it. Well, look at the facts. No, these guys are growing really well. And if you look at Microsoft, they're doing the same thing. If you look at Adobe, they're doing the same thing. Salesforce, they're doing the same thing. So the whole story that AI is going to replace software companies really fast, just the data, the facts do not line up. That's not happening. And these businesses are really valuable. So I think the market's going to wake up one of these days and say, you know what? AI is it's just been a fantasy. It was a fantasy. It's going to happen at some point. But for now, businesses like NICE are very valuable. So I got some shares in NICE. I'm underwater on those shares. I'm losing a little money because it's really had a pretty drastic pull down. Look at that. Geez, come on, stock market. Have a heart. Doesn't have a heart. It's a capitalist. Wants to make money. Now, these guys are down 44%. I looked at this business left and right. I just think it's a good business, man. I wouldn't be surprised if they get acquired because they're so darn, discounted, and you saw their growth rates. What's their balance sheet look like? Well, let's take a look. Let's take a look at the balance sheet. They got a $1.6 billion of cash on the balance sheet, $563 million of debt. So they got over $1 billion ready to go to acquire a business. Their longevity's there. Just a lot of good stuff to tell you about when it comes to NICE software. So yeah, as an investor, I got to be patient on this one. This one, the market doesn't understand it. Doesn't understand it at all. But as soon as it starts to work, I'm buying more shares. I'm going to wait for it to show me the bottom, and then I'm going to buy more shares. For now, I don't want to overbuy because it just becomes stressful. Right now, I've got a small position, not stressful. Just sitting there, just waiting for it to happen. So that is NICE software. I think if you look at other software businesses, you're going to see that theme. Salesforce is another stock that I'm buying into because I think software companies are being discounted right now. Adobe, another stock that I own, ditto, it's being discounted. Now let's talk about GCT. GCT, if I recall, is Giga Cloud Technology, provides end-to-end B2B e-commerce solutions for large parcel merchandise. These guys are small, less than $1 billion market cap, but you're buying the company for less than 1 times revenue. They have a super low forward PE. Strong buy, discounted by 200%. Oh man, what is going on here? Year to date's down 8.59, and they're down 51%. What is going on? Like this one here is a really small cap. They do big items, right? So it's not something that there's like a dominant player. It's not like Amazon does a very good job with big items like furniture and stuff like that. So they depend on, I would say, merchants that or businesses that are selling online, that are selling bigger products, are using Giga Cloud to deliver that product. When somebody orders it online, the revenue is really, really growing fast, 89%, 43% year prior, 70% on the last quarter. That looks really good. When did they announce their earnings? They announce them on March 3rd, tomorrow. Here we go. Here we go, stock market. See if they catch a rally tomorrow. So really high growth. We'll see where they come in. When we look at free cash flow, they do produce free cash flow, and they've been producing it for some time. Gross margins are not great. They're e-commerce. They're more logistics, I should say. If you look at UPS or FedEx, they're going to have low margins like this. When we look at, they do have free cash flow margin. So it's not an overly profitable business, but at their current free cash flow rate of 122, if I went 15 times that, I'd get to about $2.1 billion in market cap, and it's at 700 million. So you can it'd have to triple in value to get to its value based on free cash flows. Now let's look at that balance sheet. Balance sheet looks okay. It's only got, if you net out the cash from the debt, they have $244 million of debt. So this one here just is got really good value. It's really small. So again, when the market is scared, and right now the market is scared, not a lot of investors want to buy into a small cap like this, where it's not a really well-known name. It's just more added risk. This one here, I have a valuation on GCT. And it's discounted. It's discounted nicely. The value of those free cash flows is much higher. The earnings per share look great. Even if you just hit it with a 6 PE, you're at a very, very good discount. So this one here is just going to be misunderstood, underappreciated. And that's where the numbers are telling me. And look at the discount rate I use on this, 15% discount rate on those free cash flows. So if this thing continues to exist, it's going to really load up with cash on that balance sheet. And it's not going anywhere, because you think about e-commerce, we're doing more e-commerce, and those big items, it's becoming more popular for people to order just about anything online and have it delivered. So that is GCT. I hope things get better for them, because it seems like a really nice little business. Let's talk about, I think it's DraftKings next. And if you're joining and you put up a symbol you want me to look at, please be a little patient. I've got, looks like 5 stocks to go, and then I'll check to see if there's any other new suggestions out there. So we got DraftKings. These guys do digital sports entertainment, gaming, gambling, and so forth. Now, these guys, I've heard a lot of stuff around these companies for 10 years, maybe 15. And it has never really paid off from what I've gathered. Let's see what's going on. It's got a high forward P of 76. The market cap's 21.5 billion, revenues 4.77 billion. All right. Not too bad. You're paying, 5 to 6 times revenue for the company. It's a strong buy with a 25% discount. They are growing nicely. Look at that growth, 30%. They are getting a rather big, right? 4.7 billion. Last quarter, they grew by 13%. And when are they going to report? February 13th. They already reported. So we're going to be waiting a while before they report again. So the revenue is, see, this quarter here, it really came down. Interesting. They had a slowing of the growth rate there. 30% looks good. They're getting bigger. And we got cash flow of 407 million, but this is the first year they've created free cash flow consistently. All right. Gross margins 38%. They're taking bets. Free cash flow margin 8.55. So it's hard to forecast when you got 1 year of positive free cash flow. They're not showing a trend, a trajectory. So it's a little difficult to do a forecast there. But just to see where the numbers lie, if let's say with that growth rate, and it's kind of a lower margin business, we hit this with a 15, it'd be worth about $6 billion, maybe $8 billion. And they're way up there at 22 billion. So these here have never made sense to me. I'm glad I didn't invest, because I don't think there's been any like home runs hit from these gambling stocks. They have a little bit of debt there, 546 million. So this one's a pass for me. I just don't see how this is going to be just a really winning, investment. If you bought early on, you would have made some money. And especially if you bought here in the 2022 timeframe, you would have made some good money. But over the past year, it hasn't really done much. So it's a pass for me. The other thing that's happening, I know Robinhood is going to begin to, in essence, take bets on their platform. They call it something else. They don't call it gambling, but I think these guys are going to start seeing competition from all kinds of different players, and we'll see what happens. So that is DraftKings. TKO. So if my memory serves me right, these guys do have the UFC. Yeah. So these guys do UFC as well as boxing. $25.79 billion market cap, revenue is $2.8 billion. So you're going about 9 times the revenue for the company. Forward P is a little high at 49. It's actually closer to 50. Strong buy, but no discount. Well, that's not good. It's doing okay year to date. It's doing really well for the 1 year. I know these guys, Dana White, who runs the UFC, has a pretty good relationship with the president. So I think that had something to do with, around the elections. This really rallied up. I think the president's also attended UFC fights, so that's got to help out. When we look at their growth rate, really fast growth rate. Wow, look at that. Impressive. And when we look at their free cash flow of $508 million, gross margins of 67%, very good. Not very profitable. Huh. Okay. Still, they have really good free cash flow, very good gross margins. This company, I would multiply this number times probably 20, and that would get me to 10 billion in market cap, but it's well above that. Yeah, this one's priced a little too high for me. When I look at their balance sheet, let's take a look at that. So they have about $2.5 billion of debt. Yeah, this one's a little too high priced. Based on cash flows, I can maybe get to 15 billion, but I can't get to 25 billion. And, it's been doing really well for the past year, not for the past 5 years. That's weird. They just IPO'd. That's why. Okay. So they IPO'd and they really have gone up. So it looks good. So the stock's a little expensive. We'll see how it trades going forward. But for me, it's a pass. The PE is a little too high. Cash flows don't get me to market cap, and they don't get me a discount. I want a really good discount on the stock before I invest. All right. So Yeti. So Yeti Holdings, I believe, yeah, they do all these products, right? And I know that their coolers keep things really cold. Very good insulated product. Looks good. For a while, these guys were like a darling. People really paid up for their products. It's a $3 billion market cap company. It was doing really well, and then it just cratered. Look at that. And it hasn't come back. Down 11%. $3 billion company. Revenue is $1.83 billion. Forward P is nice and low at 12. This is a consumer discretionary company. They're selling products that are nice to have products. They are growing okay, 10%. That looks pretty good. Last quarter wasn't all that great, only 5%. All right. Now, if we go into a recession, and we're kind of having a lowering of confidence, right? I think consumers are beginning to lose confidence because they're hearing of people being laid off and all kinds of trouble. A company like this will be impacted. Yeti products are not the least expensive product you're going to find out there. You can find a cooler at Walmart for, I don't know, 20, 40 bucks. You go buy a Yeti, you're spending $200 to $400 for a cooler. So it's like, whoa, wait a second. It is a nice to have product. It's not a must have product. So these guys are growing okay, not great growth, and they did slow their growth down in the last quarter. Free cash flow is $220 million. Okay. Gross margins 59%. Very good. Profit margins are okay. All right. So I'd multiply this times 15 because their growth rate isn't all that great. So that would get me to, let's say, 3 billion, assuming they don't have too much debt. And no, they have a surplus of $186 million of cash. So they're priced fairly priced stock. I'm not looking for fairly priced stocks. I think these guys are going to have maybe some tough times ahead. If the economy contracts a little bit and people are like, yeah, I don't want to buy a $200 cooler or a $50, coffee mug that keeps my coffee, nice and hot longer. That kind of stuff is a nice to have item when things are really, when consumers are really confident, probably when they had all those stimulus checks coming in and they're basically spending money they didn't have to earn. They're probably buying a bunch of Yeti product. But nowadays, people are probably watching what they spend a little closer. So that is Yeti. It's not a good investment for me. Just doesn't have a good momentum, doesn't have momentum, and it doesn't have a very good discount based on free cash flows. Let's look at LW, which is Lamb Weston Holdings, engages in the production, distribution, and marketing of frozen potato products in the United States, Canada, and Mexico. So it does frozen potatoes, huh? So this is a food company, packaged foods, consumer staple. 7.4 billion in market cap, revenue 6.33, forward P is 15, pays a dividend of 2.85. So they're not growing. All right. They haven't grown 3 quarters. That's not good. They were growing quite well for a while. Maybe they grew through acquisition, but now they've kind of hit a plateau. Free cash flows, negative, not good. And their gross margins are low. This is food. It doesn't have big margins. Profit margins are low. So I don't like these types of companies. They just don't have, a lot of what I'm looking for. It probably wouldn't be worth much more over time. These guys, built up some of their value in the company, and that's really crashed down. It's negative cash flows. If they repair the business, maybe this could see a bump of 20, 30%. But I really am looking for stocks that are going to more than double over the next 5 years. I'm looking for nice growing stocks like those pharmaceutical companies we saw early in the live stream, like Halo. Man, that looked really good, didn't it? Really high margins, high cash flow, high growth. I mean, hey, exciting. These ones here where it has no growth, it's like, wow, well, they're just going to be a steady Eddie. Create good jobs and, distribute food that people need. That's all great. But, I'm trying to be an investor and grow my wealth. This is not going to be the right investment for me. This would be a pass for me. I can't get to this valuation. It's got negative cash flows. So thanks for asking about that. I don't get hooked on dividends, by the way. Dividends are okay, but it's not part of my decision making. Dividends are the simplest way of an investor seeing a stock and saying, hey, that's a good stock. It's a 4% dividend payer. Well, maybe it's not a good stock. Maybe it's a terrible company that knows if they put out a 4% dividend, some investors will have an appetite to buy their stock. Well, they're buying a terrible business because they're marketing the business by putting out a really nice dividend. So that's why I don't pay attention to dividends. I don't put them in my valuations. If they pay dividends, that's a nice feature, but it's not a decision factor for me. Okay. All right. I'd rather see my stock double in 2 years than you pay me a 10% dividend. I'd rather see big appreciation versus dividends. All right. LW is in the books. Now somebody had a question of why wasn't Regeneron one of the top ranked stocks out there? And it's probably going to be forward P is 16. That looks really good. Over the 1 year, this is down. Wow, look at that. I was not expecting that. 61% over the 5 year, but the 1 year is not looking very good. What's going on, Regeneron? What is going on? Year over year growth, 8%. The quarterly growth rate, 10%. That looks good. This is a pretty big company, right? $14.2 billion in total revenue and they're growing that by 8%. It looks really good. This is a pharmaceutical company. What kind of margins you got? Well, the margins are 49%, not very high margins. Okay. Other pharmaceutical companies are up there in the 80s. These guys are in the 49.99. That's still very good, very respectable. $3.66 billion of free cash. So they're a single digit grower up there, 8, 9, 10% grower. So, and their margins are okay. So I'm thinking let's look at their debt. And I'm thinking 54 before debt, 54 billion is their value before debt. And debt. So they have 9 billion in cash. And I think this is I think this is a positive number, and it's representing it at 15 billion total cash. Okay, I'm not sure I'm believing that, but so 54, let's call it plus 10 would be 64 billion, and they're at $74 billion in market cap. So I'm not even getting to their current market cap. So it's not a discounted stock. So maybe that's why I didn't get to the list is some of their fundamentals just didn't get it up there so they could muscle out some of these big margin companies with high growth and stuff, like we saw Hallow. This one looked great, by the way, but they do opiates. They're basically doing what, if you remember the drug oxycodone, and a lot of people got addicted. A lot of people got hurt by that. Some people died. A lot of people died. A lot of people got hooked, and just became this huge, huge problem. Well, this is a new company that's trying to do it responsibly. Now, I think they're probably going to do it responsibly. And Purdue Health or Purdue Pharmaceutical was the big company that just got destroyed because they destroyed a lot of lives. So the fundamentals of Collegian look great, but I don't think anybody wants to buy it because nobody wants to be an owner of a oxycodone company, including myself. I don't want to be an owner. So I looked at this one and this one as like stocks I hadn't looked at that looked really interesting. So thanks for asking about Regeneron. Hopefully I answered your question there. Looks like Regeneron is priced a little too high based on their market cap. AES. The AES Corporation. This is a diversified power generation utility company. All right. Utility company. Market cap, 8.24 billion over the last year. It's down. Wow. 5 years, down 36%. Revenue is $12.28 billion. Forward P is 5. Discounted by 76%. They're not growing. They haven't been growing for a lot of quarters. But last year, they're down 3%. So we've got free cash flow. See this cash flow here? It's negative. It's going to be because of CapEx. Utility companies have to put a lot of capital expense back into see this CapEx line? These are the parts that go back into the power generation equipment. That equipment's really expensive to maintain and it costs a lot of money. So every year they have to put back, in this case here, more money into the business than it's generating. So that's why I've never liked utilities, is the CapEx is too high. It doesn't leave cash to buy back shares, to put on the balance sheet and acquire other businesses. It's just not a desirable business for me. So negative cash. This stock is not going anywhere. I don't think it's going to go anywhere. It's just not my cup of tea. Back to that dividend. So utilities entice investors. Hey, you want that 6%? Come buy my stock. But it's a little bit of a deal with the devil, right? You lose 36 to make 6. That's like second grade math. That's a bad deal. Over the 1 year you lose 23 to make 6. Still, second grade math doesn't pass. It's not a good investment at all. I'd rather make 25% appreciation a year and no dividend. I'd rather have that investment. So this one here is a pass for me, obviously, because no cash, no value, no value. I don't buy. All right. I think I'm behind on comments, but I'm caught up on all the symbols that were asked. 2, 4, 6, 8, 10, 12. 12 symbols. Covered them, man. We're cranking on a Sunday. We are moving. All right. Let's see here. So where did I leave off here? So Ryan, do you think bigger dips are coming overall in the S&P, especially after Costco and Broadcom earnings? Yes. I think the month of February is showing that some people are quick to get out of stocks. Now, if there's a bad story out there, what's a bad story? Unemployment goes up. A conflict breaks out. You know, some bad story can cause us to really start selling off again. We're not out of the woods of this correction, right? We had a nice afternoon on Friday, but we had a horrible week. And I think people are kind of, quick to get out of these stocks, no matter how good these stocks are. Microsoft is negative. Google, Alphabet's really negative. Amazon, negative. These are high quality stocks. Think about the lower quality stocks. Investors are quick to get out of them. Some of the euphoric stocks are being sold off, like Palantir, Hims, Robinhood. They're being sold off. And I think that could continue. Now, what do I do as an investor, right? Like, am I like, just going to completely leave the market until it hits a certain point? No, I'm staying invested for the most part. I built up some cash in the month of really toward the end of the year, 2024, January, February, I was building up cash. I got a nice little cash pile and I can make it a little bit bigger so that now I'm seeing some stocks, they've gotten to a point where I'm buying them on pullbacks. I'm buying Google Alphabet on pullbacks. That one there, I was actually selling like shares like 2-3 weeks ago. And I probably saved myself some money because those shares, I can buy them back at a discount now. But I'm buying back like stock in that company as well as some others. So yeah, the answer is we could certainly see some pullbacks, but nobody can tell you that they're going to happen next week or the week after. If somebody could tell you that, they're either lying or they're geniuses. And I would say that 99.999% of the time they're lying. Rotel and Cheese. Thank you, dude. Thank you for joining. Jay Zev. How you doing, man? Good to see you again. Pedro Miguel. Agreed. I agree. And I think they're coming out. Check out their AI products. So I know enough about AI products to know when I see an application that is a real AI application and they have one. So check it out. I've been slowly DCA on NICE. I'm right there with you, Mike. Right there with you. Pedro. Okay. I'm not sure where your comment's connecting to another comment, and I'm sorry I can't make that connection. So TKO has no PE. Interesting. Okay, so they changed names, so that's why it's a new symbol. Thanks for letting me know there. What about DIN? That announced a 0.51% dividend, 51-cent dividend. So DIN. Dine Brands. So this is Michael Anthony. You're the one that makes a lot of money in places that I don't invest in. So you keep doing you, man. You keep making that big money. Dine Brands Global, together with its subs, owns franchises and operates restaurants in the U.S. So they have Applebee's, IHOP, and so forth. All right. So they announced the dividend, 8% dividend. Okay. Very high dividend. Revenue is contracting 2 consecutive years. It's contracting. Looking at the quarterly, they're consistently contracting. So it's not growing. They were doing really well in 21 when everybody's getting stimulus checks. Hey, let's go out to eat every night. Let's do it. Spend a little extra money. But now, like I was saying earlier, when we were talking about Yeti, the consumer is being careful. They're like, you know what? Let's not order DoorDash every night. Let's kind of make a couple meals at home, a couple times a week, save a few dollars. And I think the restaurants are going to feel it. These guys are feeling it. Now, before I leave here, let me take a look at some other fundamentals. Free cash flow is there, 114 million. All right. And their margins, gross margin, 47%, profit, 11%. It's not bad. This is a well-run business. Okay. So 114. Yeah. These guys are discounted, right? Because even if you took their free cash flow and multiplied it times 5, you're up to like 600 million based on their free cash flow. Let me check their debt, see if they have a lot of debt or a little debt. So they do have $1.42 billion of debt. So that's where the money's at. 1.42 billion. $1.42 billion of debt, and their market cap's 382 million. That's not comfortable for me. I'd be like, I would not buy that company. It's mostly a debt-driven company. You know what I mean? Like $382 million market cap. Their debt is worth 1.5 billion. No, thanks. That's why their PE is so low. Now they entice investors. Hey, I got an 8% dividend for you, along with a 45% loss. Nope. No, thank you. Yeah, pass. I will pass on this one. Not my lane. Other people can make money here, not me. I'm going to stick to software companies, healthcare, pharma, little industrial here or there, communication services with Meta, Google Alphabet. I mean, I make good music in those zones. And if I want lower risk, bonds. If I put a little money in crypto, it's done really well over the years. Okay, great. But these businesses, I'm not excited about them. I'm like, on principle, I'm like, why do I want to own a restaurant? You have to pay a lot for the lease. You have to hire a bunch of employees. You're making very little money per customer. They come in, they order $20 worth of food, and you're taking a lot of liability because they come into your establishment. People slip and fall and they sue you. Just on and on. No, thank you. I don't want to run a restaurant. I don't want to own a restaurant. I want to eat at a restaurant. I like restaurants. I like to be customers at a restaurant. NVAX, is that Novavax? It is Novavax. Up 38%, down 29%. Look at this chart. Bam. But the last year, investors got rewarded. 1.34 billion in market cap. This is a biotech company, promotes improved health by discovering, developing, commercializing vaccines. So these guys were into the vaccines around COVID. They probably took off like a rocket ship, which they did. Rocket ship ride. And then the rocket ship came back to Earth. And it looks like it hasn't done, compared to the previous stock price, it hasn't even come close. But hey, man, if you were in the stock for the last 12 months, especially If you bought here in May of 24, you almost doubled your money. That looks pretty good. Pretty darn good. All right. 134 billion of market cap, revenue is 682. So you're paying 2 times revenue. Looks like the company's not making money at this time. The revenue is negative. Let's look at the quarterly. Really doesn't look good. Really red. Wow. Okay. So really red. Profit margin is negative. Free cash flow is negative. I can't do anything with this one. I don't know what to do with this. This one here is not going to value anything because they're all negative numbers. Unless you know something like, hey, Novavax is coming out with some new product, new vaccine that does something super cool. Like really, it's the cure to the cold. You take this vaccine if you start feeling symptoms and boom, you got rid of the cold. Boy, that could really sell. Something like that would really turn things around. And if you understood that and were like, hey, this was up 18%. What was the news? February 27th, excuse me. So that was on Thursday. So the 5-day. So look at that. They went way down. They announced, and then it went way up. So I would go study the news. What happened? Why did investors come back and start buying up the stock? Interesting. Maybe that's why you asked is, hey, what the heck's going on with Novavax? Caught my attention. I want to make 18% overnight. Sign me up. So Cheesecake Factory, Symbol Cake. Yeah, we've looked at it and that one doesn't, it's not my investment. I think some other investors buy into Cheesecake and they do quite well. So, hey, you go make money the way you feel you've got a really good process and you can keep making more money, more power to you. Pick those industries that you feel you can master. You can keep making more and more money year after year. Go for it. If cake fits into that plan of yours and you're making lots of money, go for it. All right. Believe it or not, I think I've covered about 14, 15 stocks. I'm caught up. If you guys want to ask for anything else, I think I've got a few more minutes. Let's see if it is 7:22 Eastern. Wonder if Asia's already trading. So the Nikkei is at their lunch break. Okay. They opened. And I don't think this one's open yet. Yeah, this is Shanghai. No, this is Shanghai, excuse me. And this one is Friday. No, this is March 3rd. So China's down. Okay. All right. Trader Joe, Trader Prad, replacing Fort Knox with crypto since there isn't any gold in there. I don't know. I think there's gold in there. Do you have a prediction for Hood? I think it's going to go up because Robinhood always catches a tailwind if crypto is moving. And I still think even though Robinhood has been doing really well, like it's up nicely, I still think it's discounted because it's just a very good run business with good cash flows. So I still think it's discounted based on its intrinsic value based on cash flows. The only thing I'm pumping the brakes on buying any more shares because it's just done really well and it just did it really fast. So I'm like, okay. It went up 200%. You could see from November to mid-February, it was up 177%. So, all right, we're not going to sustain that for a whole long time. So I actually sold off some shares. Like I invested 20 grand and my money ended up going up to 100 grand. So I started selling, trying to get back down to 80 grand. And I sold maybe about $10,000 of stock. And then the market helped me get back to 80,000 really quick. So I think I'm sitting on like $80,000 of Robinhood. This has been the best performer in my portfolio. I still think it's going to keep going up because Robinhood is breaking the rules. It doesn't even follow the rules. It's like, no, we make the rules. Okay. They're starting out with this new gambling business. They're like, no, we're not going to do gambling that DraftKings is doing. Those guys are competing with everybody. I forgot what they called it, but they're going to do some kind of like, you can gauge. I forgot the name. I got to look it up so that way I know what the heck I'm talking about. But I heard their CEO talking about it, and he kept correcting the journalist because the journalist kept asking him, so you're going to go into gambling? He's like, no. We're going to do some type of other type of risk taking. And they're going to get into that category. So that's probably going to grow for them. But I think if Bitcoin is trading up, which it has been, I think crypto, it's at 93. It was as low as like 77,000. So if it's in the mid 90s tomorrow, I can only imagine Robinhood's going to trade up. It's already up 1.2%. So I'm good with Robinhood. Joseph Aragon. You want to check out Geo. Private prisons. So Geo is probably going to do really well with the Trump administration. You can see that when Trump got elected, boom, look at that. It just flourished. Year to date, it's not doing all that hot. I think a lot of people bought into it, expecting these guys are probably going to see, and not a giant surprise, right? The new administration's going into government saying, hey, we got to make government smaller. We got to have fewer employees and all that stuff. I'm not saying I agree with it. I'm not saying that I disagree with it. I'm just calling it kind of like reporting the news. That's what they're doing. Well, prisons, I think that's what these guys do is they engage in running prisons in the private sector. Now, that could be a pretty interesting social conversation, political conversation, which we're not going to have. I could just tell you this business kind of makes sense right now. It's forward P at 26. It's not very exciting from a growth perspective, but I could see these guys in a year, 2 years getting more business because maybe the government says, hey, we want you to run these, additional prisons for us because we don't want to have the employees and have the overhead of running those prisons. That could be it. Let's look at their fundamentals real quick. So they're not growing a whole lot. Okay. They do have free cash flow. They've been consistent in their free cash flow. Okay. Gross margins, not that great because it's a prison. They're probably doing like cost plus, or they have to have certain margins. And free cash flow is okay. So, I mean, this business is maybe worth, let's take a look at debt, make sure they're not swimming in deep debt. They got about $1.73 billion of debt. So I was going to say they're worth like $2 billion, but now I saw the debt level. So free cash flow is 211. Maybe they're worth 2 billion, maybe 2.5. Then you deduct that debt and you're down to 500 million to $1 billion. So yeah, I'll pass. Investors jumped into it because they're like, oh, with Trump in office, he's going to send so much business their way. I think it may, but maybe in a year or two, and you're going to have to wait for it. And now the stock price is really bid up. Fundamentals don't support this market cap, not even close. So no, thanks. Somebody else can invest in that. So thanks for asking, Joseph. All right, we're 20 strong on the live stream. Let's talk about Exelixis. Exelixis is a oncology company. This is a pharmaceutical biotech company. They are doing medicines for hard to treat cancers in the US. Okay. These guys are saving lives. And it's a $10.8 billion market cap company. Revenue, $2.17 billion. So they're about less than 5 times revenue. No, they're about 5 times revenue, I should say. And we got forward P of 19. Okay. The stock has been working, man, working nicely. The secret is out. The word on the street is these guys are legit. Looks beautiful, man. Stock appreciated nicely. 18% growth on that revenue. $2.1 billion market cap company. Very nice. Just take a look at their gross margin. Look at this gross margin, 96%. This is the kind of business I'm looking for. Beautiful margins. Profits, after they've paid for everything, 24% profits, 31% free cash flow margin. Bam. That's why their stock is just flourishing. This is a very valuable business. When we look at their free cash flow of $671 million, more than doubled. Boom. This is the real Hims. Hims can't touch this. Hims doesn't have patents like these guys do. They just got a bunch of marketing, and these guys are legit. So these guys are worth, in my mind, like potentially like 14 to 21 billion, and they're at 11 billion. So this one here is going on my watch list. Let's see here. All right, let's bang out another valuation. This one's too good to wait. Got to get ready to do some trades this week. I got to keep up with Trader Prad. He's making all that money being a trader. I lost some money in February. I'm still up for the year, but I gotta make up for a bad February. All right, so I got in another screen, I've got this data. Now let's take a peek at this guy. We're going to go right back to Catalyst. And here's the valuation that I completed earlier on the stream. Let's make a little bit of room here. Got to check out EXEL. Okay, so EXEL, and that is Exelixis. We're going to keep the discount rate at an elevated level because it is a smaller company. Okay, so the free cash flow is 671. They're growing their top line by 18%. Quarterly shows that they're growing at 18%. So really consistent growth, 18% top line growth. The free cash flow more than doubled. I'm not going to double it every year. So we're going to go, free cash flow is going to grow by 20%. And so that's there. So there's that $18 billion. That's what these cash flows are worth. These companies are valuable, man. Let's see here. We've got, man, you got to love these companies. $1.1 billion of cash on the balance sheet and only $215 million of debt. They can write a check. They can put it on their American Express card. The shares outstanding, 279. 78% discount. The value of these cash flows in this interesting pharmaceutical company that's has a medication to help people with this really bad cancer is 78% higher than its current stock price. Even though the stock price has been flourishing, this company is very valuable. It's been working. It's been working for the last year, and maybe this thing's just going to keep flying up. When we look at how many analysts cover this stock? 17 analysts cover this stock. I want to look at I'm going to look at this with you so you can follow my train of thought. 17 analysts. So we got lots of opinions. And what I want to see is, what does the collective group think about growth? No, wait, 5% growth. Who's raining on my parade here? 5% growth. That scares me a little bit. Got to pump the brakes a bit. But then they're going to grow again. Well, what's up with that? Did they guide lower? Why is there like a slowing down of growth? The earnings per share is expanding nicely. Looks good. So this year it's supposed to contract a bit, or not contract, but the growth will slow. All right. 2.08, $2.08 of earnings per share. Give them a 24, grow by 15. This is a good company, good stock. I think I stepped on one of my other valuations. I'm going to have to fix it later. All right. So this company here is an interesting company. The kind of words out there, this is always kind of a, tricky situation where when a stock is moving up this fast, the good news is it kind of plateaued and now it's beginning to move up again. So maybe it is a good time to buy this sucker. Put a few bucks out there because this thing is worth a lot. It doesn't pay a dividend because I don't care. I don't care. It doesn't pay a dividend. I'd rather be paid 78% appreciation on my investment. I'd rather see that. And this thing didn't do much, but now it just climbed. Boom. Wow. Awesome. This is a good looking stock. So EXEL is going to go on my watch list. I am going to sleep on it. See if I want to buy some shares. Buy them up tomorrow. And now I've got 2 stocks in healthcare. That's what my analysis this weekend, I wanted to look at healthcare because number one sector. It shouldn't be a giant surprise. It's doing well. And I'm glad I did so. So that was EXEL. Get this thing ready so I can put it on my watch list, be ready to go. All right, I'll take care of the rest later. All right, so I think that's a good point to shut this thing down. We've been going for about an hour and 40 minutes or so. Joseph, thanks for asking. Bearlight. S&P. So, I didn't talk about it, so we can talk about it. So Warren Buffett, sold his S&P holding? I think there's a couple of things going on. First, I think the market is expensive, and Warren Buffett is probably agreeing with that. Second is he's going to hand the company over to his successor. And I think he wants to hand it over with plenty of cash at his disposal and kind of, just leave him with a bunch of winners, and so that he has a very good basis to operate with, and then he can make some new investments. I think that's what he's doing. I don't think he's already bet against the market, so to speak, because he's raised so much cash. That's as far as I'm reading into it. I mean, it's clear that the guy's getting into cash because he wants more cash. In fact, let's take a look at Warren Buffett's portfolio. I did a video on Warren Buffett, by the way, about a week ago, maybe a little more. And here's Warren Buffett's holdings. He's got a lot of Apple. He's bought into a lot of treasury bills. So he's really invested in the US. He's got a lot of cash. That's as far as I'm thinking about it. I don't really think too much further than that. I think the market is expensive. You've heard me say that for a couple months. If you attend my live streams, if you watch my videos, if you attend the investor calls on weekends, I've been saying that. I don't think it's, groundbreaking. It's a couple years of really great appreciation, and we have an expensive market. Okay. No giant surprise to anybody, right? All right, guys. So that was an awesome live stream. Let's see how stocks trade this week. Hopefully it's going to trade up, but don't be surprised if we just have more corrections. We don't have a lot of news. We have Thursday is going to be a big day with Broadcom. Broadcom's not going to move the market. I think NVIDIA was the big market mover. I don't think Broadcom can announce anything that's going to make their stock rise. I think Broadcom stock's going to continue to fall, in my opinion. I think it's overpriced. And we'll see. We'll see if stocks continue to settle down. If we have bad news coming to the market, it may drive down stocks. I think there's the amount of fear, and then I think consumer sentiment is really going down. So I think those together could really cause this market to continue to sell off. Over time, it's a good thing. Over time, we want stocks to go down, so that I showed you how these pharmaceutical companies, right? Like Halo, man, this thing is really nicely priced. I think I'm going to buy shares in this. It's discounted, forward PE of 12. Well, we want really good companies to show up like this. PE of 12, like imagine if we had Meta trading at forward PE of 12 with discounts that we're seeing from like in this little company. Well, we can get there if we have a sell-off. We can get there back to like the S&P back in 22, back in the good old days. The market sold off quite drastically, 25%. And we were seeing some stocks like Netflix was discounted drastically. I made good money on Netflix. Meta, drastically discounted. I could just go down the line. I could tell you 100 stocks that were discounted. That happens when we have severe sell-offs. But you look at the graph here, we're nowhere near that type of sell-off. Come on. Like we had a bad couple weeks. We need to have, this was kind of a bad 12 months. So we need to have like the pain and suffering for 12 months. Then we get those awesome prices. So right now, yeah, some froth has been taken off. Some air is being let out of the balloon. Some prices have been kind of pushed down a little bit, but we're nowhere near a really solid correction like the one we had in 2022. And I think we could probably use one of those. I know an investor of my type, I would love to see it. I'll unload my bonds and put them into stocks if I saw that again. So we'll see what happens. So that is it for the live stream, everybody. I had a great time. Thanks for joining. Thanks for all the questions. We covered well over 15 stocks on the stream. Really appreciate your involvement. Appreciate your support. And please subscribe if you haven't subscribed. Consider being a paid member if you want to join us on the conference calls on weekends. And you know where to find me. You can find me on my YouTube channel. You want to be on the Discord, reach out to me and I'll send you an invite. We're going one-on-one to keep bad actors out of our Discord where possible. And would really appreciate you joining the next live stream. All right. Good luck, everybody, this week. Take care.